You know, that exact gut-wrenching feeling when you finally summon the courage to make a major purchase, only to watch the price immediately plummet into a steep discount the very next day. It is the exact same frustration as buying a premium smartphone and waking up the next morning to discover a surprise flash sale that slashes the cost by $200. Now, I want you to take that identical wave of acute irritation and multiply it across your entire liquid investment portfolio. Imagine you aggressively accumulated Bitcoin at the $104,000 peak back in November 2024. You possessed absolute conviction, you executed meticulous research, and the long-awaited institutional adoption wave was finally sweeping the market. BlackRock had successfully launched their spot ETF, and MicroStrategy was relentlessly raising billions of dollars to absorb every available coin on the market. Yet, despite this massive structural backing, you are currently forced to watch the asset spin its wheels, bouncing erratically between the $85,000 and $98,000 marks. Naturally, you keep asking yourself the exact same fundamental question that every single market participant is currently asking. We successfully breached historic all-time highs. The institutional ETFs are officially live, and sovereign capital adoption is a verified reality. So why on earth is this asset completely failing to launch toward $150,000 or $200,000? What critical macroeconomic variable am I completely blind to? And I spend an absolute obsession-level amount of time analyzing precisely why major financial assets consistently refuse to behave the way traditional theory dictates they should. If you are a market participant who accumulated Bitcoin anywhere within the wide $18,000 to $95,000 territory over the past few years, firmly believes in the underlying cryptography, and completely respects the absolute mathematical scarcity argument, yet remains totally baffled as to why the actual spot price action feels entirely disconnected from massive institutional integration, make sure to immediately hit that subscribe button and give this video a thumbs up if these insights provide clarity to your strategy. To be entirely candid, I did not originally intend to sit down and record this breakdown. For the longest time, the pervasive online narrative claiming that major global banks are actively manipulating the spot price of Bitcoin felt like classic tinfoil hat conspiracy theory material. The exact type of unverified speculation desperate accounts tweet out at 2 in the morning, with zero empirical evidence to support their claims. However, everything shifted when I began conducting a forensic investigation into the exact, legitimate structural mechanics that modern financial institutions routinely deploy to legally suppress the valuation of major global assets. What I uncovered during that research genuinely shocked me to my core. We are absolutely not discussing some fictional, illegal backroom cartel agreement here. We are talking about highly sophisticated, completely legal financial engineering structures that have been actively weaponized throughout history to completely hollow out corporations worth billions of dollars. These methodologies are fully protected by current regulatory frameworks and carry a deep historical precedent spanning well over a century. What the average retail investor completely fails to realize is that the exact same structural playbook utilized to completely implode hundreds of publicly traded technology firms during the early 2000s, and the exact same debt leverage traps that economic empires historically weaponized to strip entire sovereign nations of their independence, is potentially being deployed at this very moment against the single largest corporate Bitcoin holders on Earth. If you legally own digital assets, you cannot afford to remain ignorant of these mechanics. Let us initiate this analysis with a historical case study that may initially appear entirely unrelated to cryptocurrency, But I give you my word that every single structural thread will connect perfectly. Back in 1982, the sovereign government of Mexico executed an economic maneuver that appeared incredibly intelligent on paper. They borrowed billions of dollars from elite international banking syndicates to aggressively fund massive domestic infrastructure systems, accelerate industrial growth, and secure their long-term future. However, there was a catastrophic structural flaw embedded within the contracts. That massive mountain of sovereign debt was strictly denominated in United States dollars, completely separate from the Mexican peso. Why does this single detail alter the entire destiny of a nation? Because the government of Mexico possesses absolutely zero sovereign control over the issuance of the United States dollar. They cannot simply print dollars out of thin air to adjust liquidity, meaning they can only procure greenbacks through physical trade exports or by continually taking on more foreign debt. Consequently, in 1982, when the United States Federal Reserve aggressively spiked domestic interest rates to combat historic inflation, Mexico's external debt service obligations instantly experienced an explosive expansion. The U.S. dollar strengthened aggressively, the Mexican peso collapsed into near worthlessness, and the nation found itself trapped in an impossible macroeconomic vice. They suddenly owed a staggering $80 billion to foreign institutions, with absolutely zero mathematical pathway to fulfill the payments. Predictably, the International Monetary Fund stepped into the crisis with what they publicly labeled a humanitarian rescue package. But if you strip away the public relations terminology, that rescue package was actually a ruthless mandate for aggressive structural adjustment. To secure the emergency capital, Mexico was legally forced to systematically privatize its state-owned corporations, aggressively slash all social safety net spending, and completely surrender its domestic markets to foreign corporate raiders. In essence, they were forced to liquidate the physical infrastructure of their own nation at a massive discount simply to pay back the elite international banks. This predatory pattern was not an isolated incident. This exact structural debt spiral was systematically deployed against Argentina, Brazil, Indonesia, and dozens of developing nations across the late 20th century. Now, you might naturally be wondering, Tom, what does a 1980s sovereign Latin American debt crisis have to do with the current spot price of Bitcoin? The answer is absolutely everything. What we are analyzing is the classic architecture of a predatory debt spiral, and the primary reason it functions with such devastating precision is rooted entirely within behavioral psychology. When an economic entity owes massive, recurring debt denominated in a currency or asset class they cannot directly control, they are not merely exposing themselves to standard market volatility. They are actively risking their long-term sovereignty and their ultimate control over their baseline assets. This brings us to the ultimate connection. This exact same structural chokehold doesn't merely apply to developing nations. It can be perfectly engineered to entrap modern corporations. Right now, there is a single publicly traded corporation that holds a staggering repository of over $60 billion worth of spot Bitcoin on its balance sheet, and their capital structure is engineered in a way that makes them uniquely vulnerable to this exact historical debt trap. Let us bring this concept closer to home with a simple real estate analogy. Imagine you own a beautiful residential home valued at $500,000 completely free and clear. You decide to open a home equity line of credit for $100,000, utilizing a variable interest rate structure. Initially, macroeconomic rates are exceptionally low, so your monthly debt maintenance is a highly manageable $400, which fits comfortably within your salary. But suddenly, the macroeconomic environment shifts, and the Federal Reserve aggressively elevates interest rates. Your monthly obligation spikes to $900, then surges to $1,200, while your primary salary remains completely stagnant. What are your options? If you lack the liquid cash flow to service the debt, you are trapped within three choices. You can sell your home in a panic. You can attempt to refinance the liability by taking on even more expensive debt, or you can default entirely and let the banking institution seize your primary asset. This is the exact psychological trap where the absolute mechanics of the structure handle the destruction for you. The exact second you begin experiencing acute anxiety regarding your capacity to meet your next debt milestone, your brain shifts into a state of panic, driving you to execute desperate financial compromises. You might willingly liquidate your property at a massive loss, simply to escape the looming threat of a total default, or you might sign a refinancing agreement with absolutely predatory terms just to buy yourself a few more months of survival. The entire time this tragedy unfolds, the institutional bank that originally extended the line of credit is sitting back with absolute calm, completely aware that you are structurally trapped. This is what I define as financial pressure without financial crime. The banking institution never violated a single regulatory law. They simply engineered a highly specific structure where your long-term wealth incentives and their corporate profit incentives are fundamentally and violently misaligned. The moment the macroeconomic environment turns hostile, rates climb and asset markets soften, the trap snaps shut. Now, I want you to scale that exact real estate scenario up to an institutional level. Instead of a single residential home, imagine the underlying asset is $60 billion worth of spot Bitcoin. Instead of a basic home equity line, imagine the leverage is composed of over $16 billion worth of complex convertible corporate bonds and mandatory preferred shares. And instead of an ordinary middle-class homeowner, imagine the entity is a highly visible, publicly traded corporation whose daily equity valuation directly dictates whether they can securely lock away their digital gold or whether they will be legally forced to liquidate it into the open market. That exact corporation exists right now in 2026. It is called MicroStrategy. And mastering the exact structural chess game taking place around MicroStrategy is the absolute, uncompromised key to understanding exactly why the spot price of Bitcoin is being artificially suppressed at this very moment. To understand the vulnerability, we must dissect exactly what MicroStrategy has evolved into. On legacy paperwork, they are technically registered as an enterprise software firm that sells business intelligence systems to corporations. But anyone with sophisticated financial literacy knows that this legacy software operation is merely a corporate shell. In reality, MicroStrategy has transformed itself into a highly leveraged, massive spot Bitcoin fund, cleverly disguised as a traditional operating corporation, and the specific capital structure they have implemented to achieve this is simultaneously an act of financial genius and a positioning of potential catastrophic risk. The mechanics of their operation run through three distinct funding pipelines. They continuously issue and sell new tranches of regular corporate stock. They issue massive blocks of convertible debt bonds, and they distribute specialized preferred shares. They immediately pull 100% of the incoming capital from these three vehicles and deploy it to aggressively vacuum up spot Bitcoin from the market. As it stands today, their corporate treasury controls an astronomical repository of roughly 450,000 Bitcoin, which at current market valuations commands a staggering worth of approximately $45 billion. Because their aggregate historical purchase price sits at roughly $27 billion, they are technically sitting on a massive, historic unrealized profit of $18 billion. On a superficial level, that looks like an unassailable financial victory, correct? However, beneath that triumphant headline lies a massive, mandatory catch. Those billions of dollars in convertible corporate bonds and preferred shares arrive with rigid, non-negotiable legal obligations. The convertible bonds carry strict, recurring interest payment milestones, while the preferred shares demand non-negotiable, structural dividend distributions. Unlike standard corporate stock dividends, which a board of directors can simply choose to suspend or eliminate during a market downturn, with zero legal penalty, preferred dividends are contractually mandatory. If a corporation fails to meet a preferred dividend deadline, it triggers an immediate technical default, allowing creditors to initiate liquidation. Right now, MicroStrategy is contractually obligated to generate roughly $700 million every single year, simply to service the interest overhead of their debt and preferred dividends, a metric that breaks down to a staggering burn rate of nearly $2 million every single day. Where does that capital physically come from? Their legacy enterprise software business operates as a mature, slow-growth division that generates maybe $100 million in clean, annual free cash flow, a figure that completely fails to cover their massive $700 million debt servicing requirement. To mitigate this structural deficit, management has built a liquid cash reserve of approximately $1.2 billion, specifically earmarked to handle these recurring debt and dividend obligations. At their current daily operational burn rate, that cash buffer provides them with an absolute runway of roughly 20 months, less than 2 full calendar years of survival. This is the exact location where the terrifying architecture of an institutional death spiral transitions from a hypothetical theory into a very real mathematical probability. Let me map out the exact mechanics of the trap currently surrounding them. MicroStrategy's corporate stock historically trades at a massive premium to its net asset value. To put this in plain English, if you calculate the absolute market value of every single Bitcoin held in their treasury and subtract their total outstanding corporate debt, you arrive at a definitive net asset baseline. Let us value it at $30 billion. Yet, despite that baseline, the public stock market values the aggregate company at a massive $50 billion evaluation, meaning the market is actively paying a massive $20 billion premium over the physical underlying assets. Why does the investing public willingly pay this premium? Because market participants possess immense psychological conviction that MicroStrategy will continuously exploit leverage to acquire more Bitcoin, and that the underlying asset will exponentially appreciate in value forever. As long as the corporate stock maintains this trading premium, their wealth-building flywheel operates beautifully. The corporation issues $1 billion worth of new premium equity, instantly deploys that fresh cash to buy more spot Bitcoin. The treasury expansion drives up the underlying asset value. The stock price climbs further in response, and they repeat the sequence. It is a stunning, self-reinforcing reflexivity loop. But we must analyze the inverse scenario. What occurs the exact moment the corporate stock completely loses its trading premium? What happens when institutional markets look at the balance sheet and decide they are entirely unwilling to pay a $50 billion valuation for a company whose actual underlying physical assets are worth only $30 billion? What happens when the stock slips from a premium into a steep discount to net asset value? The moment that structural shift occurs, MicroStrategy's capital flywheel completely locks up. If their corporate stock valuation drops below the physical value of the Bitcoin held in their treasury, issuing and selling new equity tranches would be the mathematical equivalent of voluntarily liquidating their precious Bitcoin at a severe, value-destroying loss. Consequently, they are forced to completely halt all equity issuance. The exact second that funding window slams shut, Their $1.2 billion cash reserve becomes the single, solitary barrier preventing them from being legally forced to liquidate their core Bitcoin holdings, simply to meet their daily, mandatory debt service obligations. They are placed on a rigid 20-month countdown clock. If the broader market remains depressed, and they are forced to openly liquidate massive blocks of their treasury Bitcoin, simply to satisfy their creditors, what happens to the global spot price of Bitcoin? It experiences a massive downward shock. And if the global price of Bitcoin collapses, what happens to the remaining valuation of MicroStrategy stock? It plummets even further into a discount. This forces them to liquidate an even larger percentage of their remaining Bitcoin treasury at a deeper loss to satisfy the next debt milestone, creating a textbook, self-reinforcing institutional death spiral. Now, let us examine the dark psychology behind this setup. Why would any major global banking institution or elite hedge fund actively desire to trigger this catastrophic outcome? Why would sophisticated market makers systematically attempt to push a massive corporation into this specific defensive corner? This is where the underlying financial motivations turn incredibly cold and calculating. Imagine you are a multi-billion-dollar global investment banking institution. You are surrounded by elite institutional clients, massive pension funds, multi-generational university endowments, and multi-billion-dollar sovereign wealth funds who desperately want massive exposure to Bitcoin. These are absolutely not retail day traders executing minor orders on automated consumer apps. These are hyper-regulated, ultra-conservative institutional pools of capital governed by incredibly rigid legal mandates regarding exactly what asset classes they are permitted to allocate wealth toward. These massive funds are legally prohibited from purchasing spot digital assets directly due to extreme volatility concerns, opaque regulatory frameworks, and complex institutional custody compliance laws. But what if you, as their investment bank, could engineer a proprietary mechanism that allows these multi-billion-dollar funds to acquire massive pools of pristine spot Bitcoin at an absolute historic discount? What if, instead of forcing them to pay the full market price of $95,000 per coin, you could structure a scenario where they can effectively absorb millions of coins for $70,000 or $75,000? Let us look at exactly how that institutional trade would execute. If MicroStrategy is systematically pushed into a defensive corner where they face imminent technical default, management will absolutely not attempt to liquidate billions of dollars worth of spot Bitcoin on the public open market, as doing so would instantly destroy their own liquidity. Instead, they will execute what institutional markets call a block trade. They will privately contact a select group of elite global investment banks and state that they urgently need to liquidate $5 billion worth of spot Bitcoin in a private, off-market transaction. Those elite investment banks will instantly respond that they are fully prepared to absorb the massive block, but they will demand a mandatory 15% to 20% discount below current spot market rates to compensate for taking on that immense volume of risk. Within a matter of hours, these global banking syndicates successfully acquire billions of dollars worth of pristine spot Bitcoin at an artificial discount, turning around to distribute those assets directly to their institutional pension clients at a massive markup, or holding the discounted assets securely on their own balance sheets. Either way, the institutional elite successfully corners a massive percentage of the global supply at a severe discount. But for this ultra-lucrative institutional transfer to manifest, they require MicroStrategy to actively enter a state of severe financial distress. They must systematically force the corporate stock to trade at a steep discount to net asset value, and they must let that 20-month cash runway deplete under immense pressure. How do you synthetically generate that exact ecosystem of financial pressure? You aggressively short sell the corporate stock. Let me establish an absolute boundary of clarity. I am not claiming to possess empirical evidence of a highly coordinated criminal insider conspiracy, nor do I possess secret audio recordings of international bankers plotting this out in a smoke-filled boardroom. I do not need conspiracy theories because I have access to verified economic history, and history demonstrates with absolute certainty that this exact structural playbook has been successfully deployed against corporate targets for decades. In the early 2000s, the Wall Street financing ecosystem became heavily obsessed with a specific private investment structure known as pipe deals. Private investment in public equity, specifically, a highly aggressive variant known as a toxic or death spiral convertible bond. The mechanics operated through a deceptively simple hierarchy. A publicly traded corporation facing temporary cash flow friction would approach a predatory hedge fund requesting emergency capital. The hedge fund would willingly extend a $10 million loan, but instead of demanding repayment in traditional cash, they contractually mandated that the debt be repaid exclusively in tranches of the company's public stock. Crucially, the contract dictated that the lower the company's stock price fell in the open market, the more total corporate shares the lending hedge fund would automatically receive to satisfy the debt. Think about the catastrophic incentive architecture engineered into that contract for a single second. The lender achieves maximum profitability exclusively by driving the target company's stock price as close to zero as humanly possible. How did these hedge funds systematically trigger that collapse? They aggressively shorted the target stock, distributed highly sophisticated negative research reports, and synthetically manufactured an ecosystem of total market panic around the entity. The Securities and Exchange Commission eventually launched massive forensic investigations into hundreds of these predatory pipe deals, and the historical data they uncovered was absolutely devastating. Corporations that signed these debt agreements witnessed their public stock valuations plummet by an average of 34% within the very first year of execution. A staggering 85% of participating firms experienced total negative returns, and nearly 48% of those companies were completely delisted from major stock exchanges, wiped out of existence, and driven into bankruptcy. This is not unverified theory. This is documented historical reality, where real corporations and ordinary shareholders were completely destroyed through perfectly legal, structured financial engineering. Now let us be clear. MicroStrategy does not possess toxic, floorless convertible bonds. Their specific modern debt architecture is far more sophisticated and robust. However, the underlying psychological and market incentives currently driving institutional short sellers remain completely identical. If you are an elite multi-billion-dollar hedge fund operator and you structurally calculate that a massive corporate holder will eventually be cornered into liquidating its underlying spot treasury, what is your immediate macroeconomic play? You short sell the public stock with immense volume. You apply maximum structural pressure across every media outlet, and you patiently wait for the clock to run out.